Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, and finally, what I wanted to just kind of cover with you is the idea of, in terms of how to create an options collar. So there's just a couple of questions I just want to touch on. There's just a question on there, how to hunt the stock under a values in terms of where to sell a put option. Again, you know what, I don't want to get into the details. I know Jason did a nice little webinar and some technical analysis that was prior to, and we at Option Source have a number of our own proprietary techniques for how we pick our different positions. But really, you just have to find some common sense way of doing a buy low, sell high kind of mentality in your overall approach. Now, also Tony's mentioning here that you can sell calls against the calls. Yeah, that's essentially creating a debit spread. I'm not covering debit spreads in here, but you can certainly create any combination of options. Really, in that example, the goal of what I wanted to achieve was to demonstrate to you all simply some of the many things that we can do beyond buy and hold. So I really want to try to keep today's approaches very straightforward. Understand that once you learn options very effectively, you can create as complex of things as you want in terms of option combinations and things like that. But sometimes keeping things straightforward and simple is actually very effective. It's much easier to manage in many cases. Now, the last thing I wanted to cover was the idea of creating a collar. And what basically you can think of a collar is we buy the protective put. We already talked about buying that put as an insurance policy on the downside of a stock. So we could buy that protective put to hedge the downside risk. But what if we bought the put to protect the downside risk of owning the ETF? But instead of it costing us so much money to do it, what if we sold a covered call up above to offset some of the cost of buying the put protection? So what happens is what we've really done is we've limited the upside and also limited the downside and created sort of a range. So we know what we want out of a stock, but we always remove the worst case scenario. But we were also at the expense of removing the best case upside scenario. So in this example, let's say again we bought 500 shares of that natural gas ETF. You can see I'm using the exact same ETF over and over again, but sometimes I don't want to confuse it by changing the underlying. Any ETF, the strategy can be very effective with. So let's say we bought those at 18 and we rallied up to 21, the exact same scenario. And now what happens up at $21, you say, look, this thing can keep going higher. But also, I don't want to risk losing the profits that I made. So if you look, the March $20 put was asking 30 cents. So if we turn around and buy a 30-cent $20 strike March protective put, it now locked in a guaranteed sale price of 20. So if suddenly this natural gas ETF started dropping and started going to 20, 19, 18, 17, now we're in a losing position, well, guess what? You just locked in your sale price at 20. So if it goes from your worst case scenario is you give $1 back from 21 down to 20, and then you've already locked in your sale price from there. So now, but now you paid 30 cents out of your pocket to actually buy that. In the same regards, what we can do now is sell a covered call up at the $22 strike, which is obligating us to sell it at $22. Now, it's at 21 right now, which means we gave ourselves another $1 upside potential on the ETF to, grab an extra 5% or so on the upside of the ETF. So we didn't want to cut off the upside and have the potential for it to keep rallying. And notice here, we paid 30 cents to buy the insurance, and we collected 20-cent income for cutting off the upside above 22. So it net cost us So in this scenario, we buy the $20 put to remove the downside risk. We sell the $22 covered call and create some income, and we therefore pay 10 cents out of our pocket, or $100. Sorry, 10 cents per share, and we basically pay that in there to lock in the downside protection at the expense of the upside. So it costs us only 10 cents. So it's not like an expensive insurance, not like the previous example where it was costing us 60 cents to buy the insurance protection. Here only net costs us 10 cents. We guaranteed that we're going to be profitable on the ETF, but we did that and it didn't cost us very much, but that's at the expense that we've cut off further upside, let's say in the scenario above 22. This is a very popular strategy for a lot of ETF traders because the ETFs are diversified. In many cases, you don't have that one unique scenario where one stock can just rally this astronomical amount in a very short period of time. More often not, because the ETF is diversified, it naturally just appreciates during a bull market on the upside. So by cutting off the upside at 22, you're still giving your ETF that opportunity to make you the type of return you were expecting the ETF to make you, but you've also made sure that you can't lose money on the ETF. To me, that always makes sense as a viable strategy as you go. So just remember, on options on ETFs, it gives you a powerful alternatives to buy and hold. And it's just, if you just simply buy and hold, or even if you use some basic technical analysis, just because you use basic technical analysis doesn't mean you have the psychological discipline of making the key decisions throughout the actual investment process. When you learn how to utilize these options as a tool, you can hedge risk and remove the risk of the downside of your ETFs. It allows you to generate income off of your investments as they are going, and it allows you to actually remain in control of all your trades as you're going. And this is a very powerful thing. If you can define your worst case scenario, you can define how much income you're making, if you can define where you're guaranteed to get out, what it allows you to actually sleep well at night. A lot of people that don't use options in combinations with their ETFs, they every morning they wake up, what happened in Europe, this thing, what happened in Egypt, what happened here, and it's like, what's the big surprise does the market have for us here? Well, now what happens is that when you combine these options with your ETF ownership, what you've done is you can define so many of the parameters that you actually sleep well at night, because you know what your worst case scenario is, you know how much potential you have, how much income you generated, every different aspect. Now, there's no way that I can actually scratch. This is just scratching the surface of what you can really do with options. I'd like to just kind of keep it simple. But really, I hope I gave all of you some valuable insights as to some simple, straightforward approaches of what you can do within those portfolios. We have all sorts of workshops that even Jason was talking about them earlier in the previous webinar. We have one on Wednesday and then another one on Thursday that you could register for right on our website. And essentially there's no commitment, no cost associated with it. You just have to register for it. And we go through many of the different strategies on there, and you can see on our performance how some of our different alert services and other things have performed by going onto our site. And I hope you find some value in that. But I'll take any questions here. But more or less, that's what I needed to cover with all of you. I don't know, Steve, was there something that you wanted to add on to that?
Patrick, no, first I just wanted to say thank you. A tremendous presentation. I think that you covered a lot in 50 minutes, which is no small task. And everyone should try to go to optionsource.net either tomorrow or Thursday, and you've listened to either Jason and Patrick, or just Patrick here in the last presentation, and you know that they have a lot to offer. So please go to optionsource.net. And Patrick, I just want to say great job.
Thank you very much,
here,
Steve.
and I'm just wondering, I'm sorry, I cut you off, Patrick, sorry.
No, I just said thank you. Go ahead.
From Joel, and he says the problem is that there's no simple relationship between stock price and options price. even analysis of the Greeks often doesn't help. What's your view of that? I mean, I teach options, and I talk about the Greeks. I mean, there obviously is a relationship. It's not going to be perfect, but we do know that there is a relationship between options and the underlier, correct?
Well, absolutely. Well, here's the thing. It all depends on what kind of a trader you are. Like if you're a very active trader, then you're trying to determine things through the option Greeks in terms of trying to determine how should the option behave over any short time frame. If you're a swing trader and you're using an option to try to optimize an upside on that, you can certainly look at what the delta is and how the other Greeks are going to affect you. But understand that if you just look at it in a very simple format, you say, I have the right to sell my my position at this price. And even though on the very short term, you have a slight discrepancy as the delta on the option is not reflecting exactly the same as the drop. Understand that the delta will approach 1 as all of the time value of the left inside the option decays to 0. It's just simply reflecting the short-term change. But if, let's say, I paid 60 cents for a protection on that natural gas ETF to sell it at $21, I know on an absolute basis that that it's going to cost me 60 cents, and I'm guaranteed to get out at 21. And sometimes you don't want to overcomplicate it than that. It really, in the end, the immediate hedge is not there. This is where we go into delta hedging. If you need to hedge a very, very specific position over a very specific short period of time, you need to buy the appropriate amount of puts to make the delta equal to 1. So you immediately are hedging all immediate risk on the downside that may happen over, let's say, the next day or two. But if you're talking about an ETF position, you're going to hold over the next 3-4 months, and you're just trying to build in a hedge in the bigger picture, you don't really need to worry about the Greeks too much. It really leave the Greeks for the guys that are very active and that are looking for very specific outcomes over very short periods of time.
Good point, Patrick. Here's another question from Yeifel. He says he has 2 questions. Taking into account risk-reward and probabilities, what about, so I guess, how do you do that? And what about the cases that we sold options and price went in direction against us much larger, such as the black swan? So how do you look at, if you're looking at which options to sell, in, at, and out of the money options, Patrick, and I think this is what Yeifel's trying to say, is, and how do you balance the probability that when you sell this out of the money option, the probability is that you're going to get your premium regardless, but it's going to be a good trade for you, but you're not getting much protection versus getting a lot of protection, but potential more than likely getting your underlier called away from you.
Yeah, that's really a function of market timing, and we do a lot of market timing at OptionSource.net. We're technical analysts, and we actually do a lot of our forecasting that way. And we always try to build our option strategies around our outlook on the markets. But understand, you have to build an option strategy built upon your outlook. You can't build an option strategy to protect you from all outlooks. You almost have to say, I need to build an option strategy to remove the risk of a black swan event. Well, if that's the case, then what you're doing is you're going to you would do out of the money put protection, offset it with like a collar with, let's say, far out of the money covered calls to offset the cost. And what happens is that you don't remove the immediate 10% downside risk or 15%, but you remove the risk of a 40% drop, like one of those outlier events where the market makes a very, very dramatic move. You're just trying to remove the worst case scenario. But again, that all depends on, you have to, in any option thing, options are a tool. So what happens is that when we determine what it is we think we're trying to achieve, or the risk we're trying to hedge out. Once we know what we think the risk is, we have to ask ourselves what option combination would best hedge us out for the risk we're trying to remove. You can't, you sort of have to kind of always look at it from that perspective. Does that make sense?
That does make sense. And I love, I teach options, as you know, Patrick. And I don't think I've ever said that, never even deliver a message that you just did, that you can protect your portfolio against an outcome or a couple of outcomes, but not against all outcomes. That's well put. I like that. And that's true.
Thank you.
It really is. The only way to protect against all outcomes is to sell, and then you know,
that's
maybe
called cash.
Right, and then you have risk of having too much cash. Let's see if we can find a couple other questions, Patrick. Can you do a collar on SCG Leap? No, you can go out. I think the SCG only goes out 9 months, so you can only do it 9 months. Patrick, when you look at collaring, what do you look at Option Source? What kind of collars when you're looking for your clients? What do you do?
I never really open collars right off the bat. Like collar strategies are usually best once you. The way I almost look at it is that, like, this is exact market environment right now where collars are the best. Let's say you bought ETFs back in like October, November, or even at the beginning of January, you bought ETFs, and now all these ETFs are making you money. Well, you know, there's nothing stopping the market from even rallying for another month or two or into the second quarter, and where you have further upside potential. But as this market keeps rallying higher and higher without a market correction, the risk of eventually a market correction happening increases. The markets never go up in a straight line. And so now what you're doing is you're starting to get to a situation where the easy money has already been made in these ETFs. Now you're just trying to get the last little bit out of these ETFs on the upside before we're going to have some sort of, let's say, 5 or 9% market correction. So this is a perfect time for callers because you've already made the money on the ETFs. So now you give it a little bit more upside, but do a covered call. So you give more upside potential, but you're still collecting an income. And then you buy the put to remove the risk that if the correction is very deep or strong, you were able to actually hedge the risk of a pullback.
Put. It makes a lot of sense. Patrick, I want to thank you. You've spent an hour here and another couple hours building the presentation, so I want to thank you. But I do want to give you just a brief moment or so to give us any closing comments. And I do want to remind one other point, Patrick. What time are your hours for those free no-commitment workshops for Wednesday and Thursday?
If I'm correct, because it's actually being conducted by Jason and George, but I do believe that it's tomorrow afternoon Eastern Standard Time, and Thursday it's in the evening, I think at 6 or 7 on Thursday. So either you can do it in the afternoon tomorrow or in the evening on Thursday. But we have them on a regular basis, so even if you can't make it out to one of those, if you register, we'll let you know when the next ones are. But we're going to be doing them on quite a periodical basis so just go in there and register, and we'll get you into one of our workshops and show you how we do things.
Great, Patrick. And just give us any closing comments you might have. Really appreciate it.
Fantastic.
Thank you so much.
Well, thank you. No, I don't know if anybody has gone through the sites, but my business associate Jason and myself do a number of forecasting videos for the ISE, which are on the ISE website. So they're also you can get them from our optionsource.net site. But we put some great forecasting content on there. And really, what it is that we try to achieve is to educate people on this very topic of how we can do things and invest and create the most optimal outcomes without the risk. Like, the biggest problem that happens for a vast majority of investors is that they go on these little roller coaster rides. They don't know when to sell. They don't know when to take their profits. They don't know when they should be buying, and they can't stay in control of the trading, and they become like deer in headlights, not being able to make effective decisions throughout the process. And what's beautiful about options is when you combine them with stock ownership, it allows you to be in control. And we're just trying to send the message out there and teach people how to do this and how to create a portfolio where they can remain in control of it and actually sleep well at night, know what's going on. There's no guarantees in the markets, but at least you know that you're protecting your money. You know what your worst case scenarios are. You know how you're managing your way through it. It's very powerful when you learn to the trade effectively. And then we're not talking that you even have to day trade. It's just about learning to make very good decisions. If I had to summarize it in a simple way, it's just looking at the markets and knowing when certain times within the market it's good to do certain things. And if you learn that, you actually create a value or real return in addition to just holding a standard portfolio. And so I hope everyone takes the opportunity to join us. At optionsource.net, we're very good at what we do. We love what we do, and we have a lot of fun doing it. And our members have a great time with us. And I hope you guys take the opportunity to learn more about us. With that said, Steve, I'm going to pass it over to you. Thank you very much, everyone, for joining us.
Patrick, thanks again. And just want to thank Patrick Ceresna, not only on my behalf, the ISC, but for all the attendees. As I'm getting some great comments. Patrick, thanks so much.
Well, thank you very much, and have a great evening. Thank you.
You too. Take care now.
Bye.
That was Patrick Ceresna. And again, if you're interested, please go to www.optionsource.net. They have free workshops. You can check it out tomorrow, Thursday, or they do them periodically. So please go and check that out. Just want to remind everyone that next week we have Dan Passarelli, and he'll be talking about setting up option strategies using ETFs. And then Mike Tusaw, considering diversification using ETFs. And I'll talk a little bit about covered calls on March 1st. So that's the schedule coming up. Please come back, whether it's FX, ETF, or both. We do them every Tuesday. On behalf of the International Securities Exchange, this is your host, Steve Meisinger, wishing you a safe and happy trading day. Take care, all.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.